Hi, and welcome to this week's look at the major stories affecting the markets so far. And obviously, geopolitical concerns are weighing heavily across the globe as it stands. We're going to take a look at inflation in the UK and how the British pound fared after that, particularly against the US dollar. Then we're going to take a look at NASDAQ and the volatility creeping in there, which again, we will mention these geopolitical concerns. Thirdly, and again, pretty much in line, we're going to take a look at oil prices and, whilst OPEC Plus is trying to contain supply, what other factors are now weighing on that price? And finally, it is back to earnings season in the States, so we're going to take a look at Netflix, who had a pretty good report out this week. So, we will start with inflation and the UK. Wednesday morning saw the latest set of inflation data released, and inflation came in at 6.7%. Now, the expectation was for it to fall to 6.6%, but it remains steady with last month. Had it gone down, of course, we would all be saying, oh, great. CPI continues to fall from its peak of 11.1% last year, but it remains steady. Not the worst news, of course. We could have seen inflation go up again. And in fact, the cause of it remaining steady fell firmly at the door of fuel prices in the UK, obviously direct result of what we're seeing in the oil price market. It does provide some evidence that maybe the fight against inflation has stalled, which could lead the way for another Bank of England rate rise. Well, tighter monetary policy like that equals more expensive currency. Therefore, no surprise, the pound reacted with short-term growth relative to other currencies when the data came out. If we have a look at the pound against the US dollar chart, there does seem to be a picture emerging that the pound has found some important support at the 1.215 level. September the 27th, the rate dropped below that, but rose confidently the next day. October the 3rd, the fall below this level was more significant, but the recovery again was fairly quick over the next couple of 3 days. In fact, with the bulls getting a 2% gain just 2 days later. There's long lower shadows on the candles, in October the 6th in particular, if you take a look at that day, indicate demand around the 1.215 level. An analysis of the price movement on October the 13th shows that this horizontal level continued to provide support. Now, from a bear's point of view, well, the downward channel is still relevant, but do note that median line does seem to be gaining some support properties. Again, the price action October the 13th sort of bearing fruition there. On the back of that, we can assume the price is currently clamped into the triangle shown in purple. But if it breaks, we could see some quite heavy action and a lot of volatility. Drivers for a breakdown could well come as soon as Thursday afternoon and Thursday evening, with US unemployment data coming out and the Fed speech in the evening. So it's fair to say there is a higher risk of volatility, particularly, actually in all markets at the moment. So don't forget your risk management techniques. Okay, now we're going to take a little look at NASDAQ volatility and geopolitical concerns beginning to grip US stocks. We saw a bout of turbulence on Tuesday, but the Dow Jones and the S&P managed to stay relatively flattish on the day. The NASDAQ dropped 34 points, contributing to an 85-point decrease over a 5-day average. Not the best of news. Now, one factor in this was the upward surge in bond yields worth noting. In fact, we got the highest yield since 2006 on the 2-year bond. I think it's around 5.212%. And on the 10-year bond, we've got the highest yield since 2007. This was amongst a flurry of other events as well. We had retail sales surpassing expectations and strong earnings reports coming out, which initially led us to see a rally in that morning. But unfortunately, that optimism was short-lived. Geopolitical concerns are weighing heavy on sentiment at the moment, and it's no real surprise, obviously. Investors are watching for potential repercussions in international trade relationships, particularly for the US, and obviously, other parts of the world and their historical support for certain sides of conflicts. Now, US listed military stocks were certainly in focus, and they bolstered the New York Composite Index, that's for sure. And that was another little nudge away from US tech stocks that have really been a driver for some time now. We certainly seem to have shifted our attention, maybe and hopefully only the short term, away from previous concerns we've seen over the last 12 months or so: bank contagions, tech stock challenges, and the Fed actions and interest rates. Obviously, inflation is still in play, and what we are seeing happening in certain parts of the world at the moment, it all adds up to volatility. And I think the coming days and weeks, hopefully shortest term possible, watch out for volatility. Don't forget your risk management techniques. Okay, now we're going to turn our attention to commodities and particularly the oil price and additional factors that are now influencing it in terms of Joe Biden, Israel and Venezuela. Now, we've spoken long and hard before about OPEC plus countries trying to restrict production and supply to buoy that price up a little bit. If we take a look at the price action, we're pushing off the lower boundary of the ascending channel. In fact, the price of Brent crude oil rose 8% amid fears of an escalating conflict in the Middle East. This causes problems for the US economy, already suffering with high inflation, and for Joe Biden in terms of being on the eve of some serious elections, and obviously affects other nations such as the UK, again battling even higher inflation. And we mentioned that one of the reasons that UK inflation remained flat was fuel price rises, directly correlated, of course, with oil prices. The situation is definitely aggravated, I should say, not aggregated, by US oil reserves being at pretty much their lowest level since 2014. Now, this is pretty politically important, particularly in the US, so we can assume that one of the goals being containing the rise in the oil price of Joe Biden's visit to Israel was that. Now, obviously, there are much bigger things there, and peace and stability probably the main driver. But I do think, obviously, Joe Biden going over there Wednesday, Rishi Sunak, the Prime Minister of the UK, going over there Thursday and Friday, this is in the back of their minds without a shadow of a doubt. The price may well be affected on Thursday by Biden's speech from the Oval Office, which will be late Thursday evening US time. Worth keeping your eyes on reaction to that. Also worth noting that the US has eased sanctions against Venezuela, probably not surprised to learn, has the largest oil reserves in the world. Now, if we have a little bit of a look at the technical analysis, a rally from the October lows B after a decline from September highs, that's shown as A, may confirm that important divergent drivers are having a bit of a battle in the market. The Brent chart shows that the resistance provided by the median line of the ascending channel is in play. There's also resistance observed at $91, which proved to be quite a good support level back in September. The presence of selling pressure is evidenced by the long upper shadow on the candles on Tuesday. But will all of this resistance hold if the situation changes or worsens in the Middle East? Again, volatility. Risk management techniques are going to be key. And as usual, taking as much information you can with regards to what's going on in the world when you're making your trading decisions. Okay, so we already mentioned earlier that earnings season is in play, and the fact that there's been some pretty good reports so far. I'm going to take a look at one in particular, and Netflix soars 12% after its own strong report. Now, Netflix closed Wednesday at $345.83 per share. Thursday morning pre-market, we've seen that increase to over $390 per share. So what did the report say? Well, earnings per share were $3.73 against an expectation of $3.49. Pretty good number, really. Revenue was $8.54 billion compared to the previous year at $7.9 billion. Possibly the biggest surprise was in subscriber numbers. Bit of a tongue twister. They were up 8.76 million individuals. Now, we had about an expectation of around 6 million, so again, a good number. And in fact, that means that they have almost 250 million subscribers in total worldwide. Also worth noting that Netflix are putting up their prices for subscribers, which could obviously lead to an increase in earnings per share in the future. Now, if we look at it from a technical analysis point of view, the price has returned to the ascending channel that was previously in effect. A false breakout pattern now, could become support zone. And importantly, the price has gone over and above $370. Now, since September, Netflix has been a little bit of a laggard in the NASDAQ index, but this could well help it turn back into a leader, with executives talking of a multi-billion-dollar revenue stream coming over time in a letter to investors. Pretty strong language. Now, resistance to this bullish sentiment could come from the following. We have to mention that could well happen. The psychological level of $400 per share really could well come into play here. After that, we've got a $412 level of support. That was support back in the summer, but it was broken by a bearish gap September 13th to the 14th. So it could well slow any rally as we move forwards. Also could become quite important is the Fibonacci resistance level of 50% of the decline A to B. That could well help slow any rally as we move forwards. Now, tip ranks analysts have a target of $450 per share for Netflix. Okay, that could provide some momentum, but obviously on the back of the report, this could well change as well. So if we look at the report in isolation and try to put aside what's happening in the rest of the world, pretty strong and positive set of results could well help drive the market forwards. Anyway, we wish you luck for your trading in the week ahead. Bye for now.